Thank you for joining us for our Community Business Workshop, Accounting Basics, Get Your Books Right in 2020 Part 2. The Community Business Workshop series is made possible with the generous support of MUFG Union Bank. The Community Business Workshop series is a collaboration between the Polsky Exchange, the IJ Clinic on Entrepreneurship, and the University of Chicago Office of Civic Engagement. The goal of the series is to provide Southside businesses and entrepreneurs with substantive and actionable programming to grow and sustain their businesses. In this workshop, we'll cover how to read and understand the following financial statements: cash flow, profit and loss, and the balance sheet. I would like to introduce our speaker, Rowan Richards. Rowan, prior to joining Accion Chicago's Director of Coaching and Connections, Rowan Richards founded Assemblize, an early-stage venture capital firm focused on impact investment opportunities in Chicago. Rowan also taught a personal career development class at Roosevelt University. Much of Rowan's experience in the social impact space came from launching the Stewards Market in 2006 and leading it full-time since 2010. Prior to 2010, Rowan was a senior trader at Marquette Partners, LP, with 9 years of experience in the domestic and international futures industry. If you have questions, please enter in the chat box at the bottom of your Zoom screen. Once we wrap up the webinar, we'll leave some time to answer some questions. With that being said, let's begin. I'll stop sharing my screen.
Okay. Well, thank you so much for the introduction. And I know even since we last spoke, a lot has probably changed for people, right? So there's ongoing work that's taking place, and hopefully many are finding the resources necessary and are really in better shape to either relaunch or, put towards those efforts to either get your business started for those who have existing businesses, to get to the point where it looks a lot more like how 2019 was wrapping up and how the beginning of 2020 was starting. So with that being said, I'll share my screen so we can jump right in. Today's focus will be on the specific financial statements that we left off on last time we met. So give me 1 second, I will pull this up and we will get started. Second. Okay. Hopefully everyone's seeing a document with bench on the top. Is that correct?
Yes.
Okay, great. All right. So there are a lot of different options I could have went with, but I did choose some of the resources provided by Bench. Bench is a fantastic bookkeeping and accounting firm. We've worked with them over the last couple of years. They've provided both a bookkeeping solution, access to bookkeepers, but also throughout COVID, they've been a tremendous guide on different things, including Paycheck Protection Program and just different recovery planning options that I found helpful for people who are either starting or who have existing businesses. So for today, I wanted to use some of their resources. I think they give a really concise view of the primary financial documents, financial statements that we're going to discuss today: balance sheet, income statement, and cash flow statement. During this time, I want us to gain a basic understanding of what each of those statements are, their purpose, and how they are connected to each other. And we will definitely leave time at the end to answer any questions that you may have, that you had coming in, and that you may have at the end of our workshop today. So I could have started with any of the three, but I decided today I want to start with the balance sheet. And the reason being is that the balance sheet has certain information in it that will only appear there, and then certain bits of information that will appear in either the cash flow statement or the income statement. So when we're done looking at the balance sheet, we'll jump over to those other documents and get a chance to see just how connected all three of these statements are. But even more importantly, as you can see, the balance sheet, what it really does is give you this snapshot of this historical performance of your business. It is the place that accounts for the money that's been generated, assets owned, liabilities, and the ownership of the business owner throughout from the beginning up into the current time. So a balance sheet has a very specific role to play. So I'm going to scroll down here a bit so we can get to the point of just looking at the three different categories, and then we'll look at a balance sheet as a whole, just so that we can see how you will have a chance to look at any sort of balance sheet that you have when you're running your business and generating that document, what you can expect to look for, and how each of those sections are so important. So briefly, let's go through the three different sections. So for a balance sheet, you're going to see it broken into assets, liabilities, and equity. And again, that's going to be, this balance sheet is a collection of information. It gives a snapshot of how your business is done for the life of its business. We start with assets. These are, in this list here, you can see the different things that you can expect to see, potentially see within assets. For any business, top of the list is going to be the actual dollars that you have, money in the checking account, money in your bank accounts. One of the biggest assets that's true for just about any business. Included in actual dollars, which is the most, what they say, the most liquid form of asset that you can have, is actually converted already into cash. Along with that, you'll also see something called accounts receivable. Now, accounts receivable is one of those categories that you won't necessarily see in all three of the documents. Accounts receivables speak specifically to money that's been earned, right? So for a product that was sold already, for services that were rendered that you've not yet collected payment for. Typically, this is connected with invoicing, right? That's how we if you want to relate it to something, you've performed a specific service, you've sent the invoice to the client, and they've not yet paid you. And that's not unusual. That's often based on the payment terms that you may have. You may have net 7, 14, 15, 30 days, depending on who your client is. If it's a government contract, it could be even beyond that. We could be looking at 45, 60, even 90 days before you get payment. So accounts receivable, you've done the work, you've earned the money, you just haven't been paid yet. But it's still considered one of your assets. I'm going to scroll down. For the sake of time, I'm going to move through some of this. I'm going to get to the actual statement itself so that you can visually see how everything aligns. Longer term assets, things that are not quite as liquid, they would take some work to be converted into actual dollars. Something such as a building or land. It has value, it is an asset, but it still is not yet turned into some form of currency that is easily exchanged for other items. So we put those in the longer term asset category. Machinery and equipment, again, these hold value. You'll see something in here that talks about accumulated depreciation. And when we talk about depreciation, so anytime you have equipment, there's a value of that piece of equipment minus what's been depreciated. So if you buy a piece of equipment for $20,000 and we realize that it's going to depreciate by $2,000 every year for the next 10 years, every year on your balance sheet, you're going to subtract that $2,000 so that you see the value of it be reduced each year until that full depreciation is realized. So depreciation does impact certain assets, and it needs to be accounted for. All right, so I'm going to slide down so that we can take a look at the full statement so we can get a sense of what this is going to look like. But before I do that, here's the basic equation that you want to think of for your balance sheet, how this all needs to make sense. You'll see the simple formula, assets equals liabilities plus owner's equity. And we're going to talk about this liabilities and the owner's equity here in just a moment. But if you think about it this way, for every asset that you have, right, so let's say a building or a piece of equipment, you acquired it in different ways. So was it through borrowing money, through a loan, or through investment, through someone else's investment? Or was it through my own savings that I was able to purchase these assets? and wide range of assets is right. So either sales that I've been able to accomplish, the building, the equipment, other things like that, any sort of IP, those were acquired with capital, and that capital either came from my own savings, my own investment, or which would be my owner's equity, or through the liabilities, a small business loan, credit card, or from private lenders, whatever means were necessary in order to raise the money to purchase the assets. So you add money borrowed and then your own personal dollars that you've invested, and those things should be the equivalent of the assets of the business. If those numbers do not equal out, then it's not a balanced sheet, and we need to go back and figure out what's missing, why those numbers not equaling out. Okay, so sample that they give through Bench, a sample company of what it would look like. Assets, liabilities, equity. Again, what we'll see is that in the sample, the total liabilities and the total equity are equivalent to the total assets. Money that's either owed, money that we borrowed, plus the money that we personally put into the business, those things are equal to the assets of the business. Okay, so the basics of a balance sheet. So let's talk about some of these liabilities here. So accounts payable, if you think about the opposite of accounts receivable, which is money that's owed to you for work that you've done, the opposite is also true. For anything that you've received that you've not yet paid for, those would fall into your accounts payable. And then for debt, there's actually, in here they give an example of long-term debt, but there's actually both short and long-term. So we'll use the 1 year mark to discuss the difference between what would be long-term and what is short-term. So, less than a year, that would be considered your short-term debt that's owed. Anything that's more than a year, we consider that your long-term debts, okay? And then if we move to owner's equity, here's a few things to consider. Is capital, right? How many dollars have you put into the business itself, right? How many dollars have you put into the business to help with the purchase of those assets, to help with the startup costs of those assets? Retained earnings talks about all of the money that you've been able to generate. So if you take your revenue minus those expenses, those are what we consider retained earnings over the course of time, not in any one particular year, but over the course of time. How much have you been able to retain? And then the drawing, the owner's draw, right? So this is money that end up coming back to you as an owner that the business provided for. So all of those will add up to be the total equity in the business that you as a business owner does have in that company. So the equity plus the money that you do owe, those two things allowed you to accumulate these assets in the business. Okay, I'll pause there. I'm actually happy to answer if there's any questions now, I'm happy to answer them specific to the balance sheet. If not, we can save some of those questions for the end, and I will move on to one of the other documents. So,
Rowan, there is a question.
Yeah.
It's, as a technology company, we spend time creating code. We aren't being paid for it and only had to buy a laptop. So if we sell code, how can it balance?
If you sell your code, okay, so right now it sounds like there's no revenue coming in, right? So that there's only been expenditure. So right now your asset side would be the equipment, your computers, right? So that would fall into your assets category. How they were paid for perhaps was just from owner's equity. So you may have zero liabilities right now. So this number here, this 2,100 would be zero. This 6,900 would be the cost of the equipment and any other cost that you may have had that you've put money into yourself. And, so right now, again, assets are whatever equipment you have. And then on the balance side of that will be whatever money you spent for it. So now if you start selling, is what it sounds like, if you haven't got paid yet, and if you do get paid, it falls into a bank account, right? It's the asset of cash, money that's in your bank account. If you provide the work and you have to wait to get paid, then it falls into accounts receivable. I hope is that helpful?
Feel free to unmute yourself if you have a question or if you need to comment, but I'm assuming it's helpful.
Good. All right. So if there are no more questions on balance sheet at the moment, then I'd like to now move over to our profit and loss statement, also known as an income statement. So you'll hear both terms used, and here they're called income statements. So while the balance sheet speaks specifically to there's this ongoing record of, I don't like this one in particular. There's this ongoing record, right, of how historically the business has performed and how its assets look next to equity and liabilities, right? So there's a balance sheets are often talking about a ratio, right? Like what is that ratio? What's that balance between both sides? For income statement, it's showing, how profitable your business is within a specific reporting period, within a specific time. So you may decide to run an income statement every quarter or every month. You might decide I need to look at it year against year. What does 2018 look like compared to 2019? And that is going to be dependent on, what questions are you looking to answer? Are you looking to see which is your best month within the year? Do we want to see, which quarters are best? Do I want to see overall growth over the course of multiple years? It really does depend on what you're trying to accomplish. So for our purposes here, we'll just talk about, what we're looking at within an annual income statement. But regardless, the information is still captured in the same way. So for an income statement, there's going to be three main categories, but that will be broken up even further. So for an income statement, at the top, we're looking at revenue, right? We're looking at revenue. Let me give you a good example here. Where for us, it's like, what is all of the money that's coming in, right? So we want to know all of the money that's coming into your business, right? So perhaps that is, you have both a product and a service that you're providing. You may have 15 to 20 different products, or you just have one specific service that you offer, and that's your whole top line. Regardless, it's really important to know as much information about that product as possible. So if you have multiple products and services, you would like to list all of them. It's not enough just to say total sales. That does give you a snapshot, but it still limits the amount of information that you have. So capturing the total sales that you have by product or by service is really important. So that is at the top of the line, revenues, right? So revenues is most important information to start off on your statement. Next, we're going to have expenses. And expenses can be broken up into two main categories. We're looking at both cost of goods sold, right? So what are all of the costs specific to producing that product or producing and delivering that specific service? So one of the, if you have a physical product, you would think about it. We work with a lot of food and beverage companies. We work with a wide range of companies. We work with a lot of food and beverage, and ingredients are key, right? So if I have a food business, my food costs are going to be one of the major costs involved with the actual product. So my cost of goods sold largely will be made up of my food costs. If I have a catering business, it's going to be food costs, and it'll also be the labor for actually serving the food, right? So depending on what type of business you are, that will determine some of those costs of goods sold. Those are directly connected with the actual sale, right? So the more I sell of a product, those costs will be in step with it, right? My per unit cost for one sandwich, let's say it's $2. If I produce 50 of them, I know that my overall cost of goods sold will be 50 times that per unit cost. Unlike my cost of goods sold, there's also operating expenses. The operating expenses are the ones that are more fixed, right? Regardless of how many chicken sandwiches I produce in a week or in a month, my rent most likely will stay the same, unless it's a cost where I'm renting space. And those who are in shared kitchens may include the cost of that kitchen into their cost of goods sold, because I may need to rent more hours if I have more catering jobs. But if I own a restaurant, that rent's fixed. It's going to stay the same. And same is true with other costs that I may have within my operating expenses. Anything that's fixed, that is not variable based on the number of jobs that I have, the number of clients that I have, would fall into the operating expenses. Anything that's directly tied to the sale and the volume of products or services that I'm delivering, that would be part of my cost of goods sold. So once we have top line, we have our revenue, all the money that's coming in. Underneath that, right below it, is the cost of goods sold. If we do that first subtraction, we'll end up with our gross revenue, or our gross income. And then from there, we further subtract all of our other fixed costs, our operating expenses, and what we're left with will be our net income. And that's the bottom line, and there's further lines on here that we could look into that include taxes, interest, and that sort of thing. But in general, even for as we're getting started, often, this is the number that we're looking for right here. Okay. So you had top line revenue, you subtract your cost of goods sold, you further subtract those operating costs, and that'll give you what your net income is. Okay. All right. So I know there'll be a lot more questions, but I'm going to jump over to cash flow so that we can get familiar with that document as well. Again, income statement has a focus on how the business is performed. So one thing, as we're jumping over to our cash flow statement, one thing I want to mention is that, this takes into account depending on how you do your accounting. So there's cash accounting, which speaks to cash on hand. And then there's accrual accounting that books revenue the minute you've done the sale, right? So there's different philosophies on what works best, but regardless, there are two different approaches to doing it. And I'm not going to say one's better than another. There are some businesses that need to do cash versus accrual, but often businesses will do accrual accounting. And what's different and where you see the difference is in your cash flow statement. So in the cash flow, let me get rid of this chat bot real quick. In our cash flow statement, what you're going to see that's different is that this is accounting for dollars in. It is exactly what it says it is. The purpose of your cash flow statement is to give you as a business owner an understanding of what cash is available. And it accounts for cash of every sort. On our income statement, something that you will notice that we didn't talk about at the top was any sort of cash that was available through loans. If I borrow money from a bank, I do not take that. And let's say I borrow $10,000, or let's say, during this COVID period, I landed one of the Chicago resiliency loans, $25,000. That $25,000 would not show up on my income statement. That is one place where it will not live. It would show up in two places. It would be on my balance sheet as both the asset and the liability offsetting each other, right? Because it's money in my bank account. Remember, the assets in the balance sheet, top line was money in the cash in the bank account. So that is real cash. It would show up there. It would also show up at the bottom of the balance sheet under liabilities because it's still money that I need to pay back. It's a loan. And it would be one of the longer term loans, right? It's more than a year. I have 3 years to pay it back. I think it's 3 or 5 years to pay it back. So I would have a liability that's offsetting this asset, and they balance out. It does not show up in the income statement because it was not income that was earned. It was loan capital. But it does show up on my cash flow statement. Every single penny that comes in and every penny that goes out shows up in my cash flow statement. Of course, it includes, as always, the income that I have, but also looking at other things, money from depreciation or the equivalent of money from depreciation, increase in accounts payable, but also increase in accounts receivable as well. So we're looking at a big picture of all of the dollars that are coming in, all of the dollars that are going out. And what's really important about this document is when you're reading it is understanding that bottom number, let's say, usually we suggest that you track it from a month-to-month standpoint. So we start off at the top with all the money that's in. Underneath it, we're subtracting out all the dollars that have been, let me get to a full statement here if I can, all the dollars that have been subtracted, right? So we have, this looks more like, they've printed this more like a income statement, but it's the same idea. That at the end of the statement, there's, let's see, okay, better look right here. Okay, here we go. You started off in, let's say you started off in January, you had $5,500 cash in the bank. You earned $3,500. All right, so boom, 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 all the different things that you see in your bank account here, all the different items that are adding up to the total amount that's in your bank account. Then you start seeing the spending, right? You see the different spending, dollars that are going out, okay? So at the end of it, it shows you the total cash flow for that month and how the period ended. You started at $5,500, you had dollars coming in, you had dollars coming out. The total increase was $500. So at the end of the month, you now have $6,000. So if that was January, if that's how January ended with $6,000, come February, this top number would be $6,000. However your month ends is how the next month begins, okay? And everybody gets that concept. So it's really important, just again, it's the whole idea is to show at any given month your cash position. So tracking the money in and money out is really important from a month-to-month standpoint. I, as a business owner, want to be able to run a report to whatever bookkeeping system I'm using and see, okay, how are we doing on cash and how did we get here, right? We can open up our bank account and take a look, but when we want to look back 3 months, 6 months, it gives you a really good snapshot of your current cash position and how you've been spending money over the course of these last few months. Now, imagine when you have 2, 3, 4, 5 years of data to pull back on. When you have that much information, even 1 year will provide you with valuable information about seasonality, what the different market trends may be, when are customers most excited about your product, and even making decisions, allows you to make decisions such as, when should I stock up on inventory? When do I need to have more personnel available to meet the demand that we can anticipate happening, because third quarter of every year has been our busiest year for the last 3 years. Or we're a retail business, and historically, the months of January and February have been extremely low. So in December, the cash that we do have on hand, do we want to spend it on inventory, or do we want to invest it in training, invest it in product development, in other ways so that we can realize that investment in profitability? It's probably not going to be in inventory, because months January and February, that inventory is just going to sit there. So using your cash flow statement is a very powerful tool of making sure that you're prepared for opportunities, but also for your planning purposes. And also really important for the slow periods when sales may be low and you need cash more than you need to have other resources, or perhaps not to be staffed as well as you are at other times. In here, in this statement, is also the place where you would list any sort of loan payments. In your income statement, you do not list as an expense the principal payment of a loan. You only list the interest, where in your cash flow statement, you're going to list both the principal and the cash flow. You capture everything in this document. Okay. All right. So we're at about 30 minutes in, and I know I've shared quite a bit, but I want to make sure that I leave time now for questions.
Great, Rowan. Thank you. If you have questions, please unmute yourself.
Hi, Rowan. I thank you for doing the second part. I was at the first part, and I appreciate you coming back to give us a second dose here. I'd asked that first question about the balance sheet and about software. So the part that I'm not quite understanding is how everything has to balance, but if we have written a piece of code and we actually sell it, we're not doing additional work or putting in additional assets to then, for them to make that sale, right? So how does that balance?
Okay, I want to make sure I'm understanding your question. Okay, so you write the code, you're selling it to a customer. What do you receive?
Yeah, we're getting paid, but then we're also selling it to another customer. So we're not having to produce it again. We don't have to restock it. It's just being sold again. So how does it balance on the balance sheet then? So what we'd end up with is we'd end up with revenue $1,000 from one company and then $1,000 from another company.
Yeah, no, great, excellent question. Let me get back to that balance sheet, and we'll take a look at something here. In that scenario, what you're describing is that, and your question's right. So while we will see that, the bank account would increase, right? You're like, okay, I didn't invest in anything else. So there's no new owner's equity going in, but this line keeps adding up, right? So where you would see that would be in your retained earnings down here. Okay. So your retained earnings, again, is a snapshot of all of the revenue minus expenses that you've accumulated as a business owner. So this will offset that increasing number up at the top of your bank account.
Hey, Rowan, this is Ishan here. I am attending for the first time. I'm an EMBA XP91 program. Question: Are you going to talk about the similarities between the balance sheet and the income and the statement of cash flow at some point in time today?
Yeah, I think I've touched upon some of it. If you have a specific question, happy to answer it. Okay. Is there any specific line item in there that you're alluding to?
Yeah. So if I go back to the whole perspective of cash, that this cash flow statement captures every single cash and not just necessarily the current, but also the future cashes as well in terms of loans and whatnot, then isn't that already captured in the balance sheet as well?
Yeah, so the balance sheet does capture a full picture of everything that you have done. What it does not provide for you is that month-to-month transaction, right? So if I'm looking at this balance sheet, it doesn't tell me necessarily what I've done and where I've spent the money or how I've accumulated, how my bank account even got to this point. Yes, I'm at $2,000 right now. But it doesn't necessarily tell the statement of in what months or by which products I've been able to generate revenue so that my account now looks this way, right? It doesn't neither does it tell me where all of my expenditures are. Where am I spending money? Why is my balance sheet showing me that I have $2,000 in my account? I know I'm a healthy business. Are my expenses really high? What am I spending money on? So the balance sheet does capture here's my current, this is like your doctor's report, right? This is the overall health of the business is right here in the balance sheet. This tells somebody how strong you are, how much assets you've had, what's your ratio between your assets compared to that cost of acquiring those assets. You know, how much of that have you retained? How much of it is through your own investment? How much of it came through leveraging debt in order to acquire the different assets of the business? So it is your health report about the business, but it does not by any means give you the detail that a cash flow statement will about how money is being spent on a month-to-month basis.
Thank you.
You're welcome.
One more, I'm just waiting, not to kind of keep asking you myself, but cool. Okay, I'll just go. Is there any example that you could provide to say, okay, so now that you see the balance sheet, income statement, and statement of cash flow, how are those used outside the company? How does people see those statements and view yourself as a company? If you can give an example, good and bad both.
Absolutely. So, you know, depending on who you're speaking with, there's different statements that are going to be more interesting to others. But I mean, one of the most specific and tangible uses and practical uses I can describe outside of you as a business owner and a manager would be for those who are trying to access capital, right? So whether you're speaking with a investor or with a lending organization like a bank, they're going to absolutely be interested in all of the above. But I'm going to tell you, there's most likely going to be a little bit more preference between different documents depending on which category. So if I'm a bank and if I'm a lending organization, one of the most important criteria for me is your cash flow, right? So there's all these C's that they talk about for underwriting for a lending organization, right? Credit matters, like credit history matters, credit score matters, your character matters, collateral, but cash will always matter. Because at the end of the day, all those things can check the box, but if you don't have enough cash flow to cover your month-to-month expenses, plus this additional debt that you're seeking, then we can't do anything, right? And, you know, even if it's not that cut and dry, your cash flow will dictate the amount of capital that you will have access to. It is that specific. There's a ratio, you know, and it differs by lending organizations, but there's a specific ratio they'll have for your available cash compared to the amount of debt that they think you can handle on a month-to-month basis. So cash flow statement is going to be required. It's really important. The income statement's important as well because it gives a bank a snapshot of how you did last year. And they can, if I want to look at the last 2 or 3 years, what I want to know is trajectory of growth for your business. And I think the income statement is a good segue for what's of interest for an investor. And you know, anyone who's at the University of Chicago, those are at Polsky, those who are at the startup phase, specifically if you're in tech, you are most likely more in line with investor capital, angels, and VC, and at this point, than you are with traditional financing from a bank. Because a bank loan would be a term loan and payments start in the next month. So more often than not, if you are in a startup that's in tech or healthcare, something that has a much longer sales cycle, then you are often, and this is a generalization, but you're often, if you're seeking capital, it's going to be from more of an equity structured type of deal. And at that point, you know, all of them are important. Cash flow is not going to be important because there might not be any. We're going to be looking at income statement projections. But if you are an existing business, assets definitely matter. Assets on your balance sheet versus outstanding debt will matter. If I'm an investor, I do want to know have you had investments from anyone else yet? Whether from a financial institution or from individuals in the form of debt or equity, because I want to know what position am I coming in as an investor. You know, where does my money fall compared to those others that you've already received capital from? Plus, what am I investing in? What have you already put capital towards? If you're offering me a stake in your business, a certain percentage, and you're going to retain the majority percentage of the business, I need to know what it is that you've already invested in the business so that I can properly value my investment dollars. So a lot of it will depend on who you're having the conversation with. And then again, why it's always critical to have access to all three of these statements to be able to provide the information based on the interest of the type of information that your audience is seeking.
That was really helpful. Thank you.
You're welcome. So for a business owner, these statements are obviously not the only three that exist, but these are three very powerful statements that if you're able to get you get to a comfort level and a strong understanding of why you're generating these reports and how you can access them at the right time to make decisions, it's really important. I mean, one of the most important things is just getting a sense of how well your business is doing, both from a short-term and a long-term standpoint. You know, we're always looking to grow our top line, very critical, right? Most founders are more interested in that. You started a business because you have an idea and you saw an opportunity and you're pursuing it. And that's usually related to the top line. Most of us do not start a business to think of how we can reduce our expenses, but it is also just as important. One of the ways, especially as you grow, you'll see, as you're getting started, you'll get this sort of formation in your trajectory of your business's growth and profitability. But at some point, you begin to plateau. And that's true for mature businesses for sure. It happens to businesses at different stages, but definitely for mature businesses. 100%, 50% growth, that's not going to happen for an established business. Now they're happy with 2%, right? They can get 2% growth, excellent. So how else are they going to find ways to increase profitability? It's reducing expenses. That's one way, right? But that's something that should be pursued by anyone. The minute you start collecting data, one of your goals should be, how do I use this to help cut my costs in a way that still allows the business to grow and remain healthy? So not undercutting ourselves to the point where we've trimmed off all of our capabilities, but doing it in a way where I'm finding the right partners, the right suppliers, so that I can provide as high a quality or even better at a lower cost. So these statements allow you to do that. There are expenses that you would have assumed were not as high, that after you start collecting the data and really start digging in, you realize that I didn't realize that higher percentage of my operating expenses went to that one line item. So that's where you start digging in. You really start digging in to see if you can make some changes, identify other ways of doing that sort of service of, covering the costs of a very specific operational need in order to increase your margins while you obviously continue to grow the top line as well.
Thank you, Rowan. We have one more question. As a single man consulting service formed as an LLC, would you recommend using bench monthly service? And is it easy to transition to independent bookkeeping after using bench?
Yeah, so I really do like bench, and I'm not here necessarily to endorse anyone, but I will say this: I've had experience, hands-on experience with three, and they all provide different value. So bench is excellent if you have a need to historically go back and perhaps get your books organized. Excellent service there. They do provide an affordable service for businesses based on the size of your company, and they do have access to a pretty deep list of bookkeepers that you can kind of build that one-on-one rapport with and do ongoing, consistent check-ins and help with evaluating what you're looking for. The other two that I have experience with would be Wave Accounting, which is a very affordable because they have an excellent free version that provides free bookkeeping and invoicing. They obviously have paid services as well that you can decide to sign on for. But it's easy to get started. Integration's really good. So I've used that and found lots of success with their product. And then the third one would be QuickBooks, which is kind of at the top of the list. It's the top of the class. The key of QuickBooks, if you're going to use it, is to make sure you set up your accounts properly. If you do not set them up properly, then you're going to be a bit lost, and your information will not be categorized properly. So make sure you do the initial setup well. Use the resources that they have, which the two primary sources for guidance would be watch any one of the many tutorials that they have. They have a ton of video content that you can use to answer specific questions. And they also have certified QuickBooks trainers that are actually that are excellent. But I would suggest, if you do decide to work with a QuickBooks expert, that you go through the app itself and use one of the people that are selected. That way you can be certain of their quality. They've been pre-vetted.
Thank you, Rowan. And just one last question. Any specific books you would recommend for learning this with real examples?
I love it. I probably should have read something recently. I've been pretty deep in just working on it myself as a business owner. I'll follow up with a suggestion. I have not read anything on bookkeeping in quite a while, but there are some great resources. But to be honest, I've been going directly to a lot of the providers. Again, a group like Bench, go directly to what QuickBooks has offered. They provide so many excellent resources that I think a lot of your questions could be answered from. Now, of course, a lot of them do pertain to their specific products, but the principles are all the same. You know, if you look through any one of their resource guides, all the principles are the same. They will, of course, then direct you towards one of their tools for the ultimate solution. But yeah, I think those have been my resources of late. But I've been happy to follow up and provide some other books that I think would be really good for those who are getting started and just want that, maybe looking for that one-on-one access to information and just guidance on how to get the foundation for proper bookkeeping.
That would be great. Feel free to send it to me, then I can just share it with the rest of the group.
Excellent.
Okay, we only have 5 minutes with Rowan, so if you guys have a question, say fast.
And as always, if you don't have a question now, you're always welcome to reach out, schedule an appointment. Happy to meet with anyone to talk about this or anything specific about your business. Happy to do that as well. Our coaching program is geared to work with businesses from idea stage all the way through mature stage. So, and what you'll find is, which is great and consistent, is that regardless of what stage business you're in, these reports will always remain important. There's every CFO across the globe are looking at these documents as well. They get a little bit more complex, a lot more line items, but the basics are still there. Same principles still remain, and for the same purposes as well.
Okay, we have one question regarding these online accounting options. How do people reconcile with paper items? So checks, receipts.
Yeah, there's one, you can actually start doing all of that online, right? So you can do through their tools, you can issue checks, you can do all of your receipts there, invoices. So every time you get paid, you can mark it off and you can generate a receipt that way. If you are getting actual paper, paper receipts, depending on your business type, or for specific clients, you can enter that information. They have scan options as well, where you can just scan it through your mobile, so that you can just input all of that information directly in, so that you capture everything. So, they've created features to help kind of bridge from both the virtual and the physical documents that go along with running a business.
Thank you, Rowan. And do you know of a good accounts receivable service?
A good accounts receivable. So I guess we're speaking of having a hard time actually giving payments, if I'm not mistaken. I'm not sure.
I guess so. Maybe keeping track of it, like your accounts receivable, making sure you get paid.
What's great is that all of that gets tracked within your bookkeeping system. You'll see both money that's you've already received and money that's still owed to you. So as long as you are issuing invoices, you'll have access to all of that information. What money is still outstanding. So you'll have a record separate of money that is still in the receivables category. And you will automatically receive reminders of things that are past due. So if you set the terms to 14 days and 15th day comes and you haven't received payment, you will get a reminder. You will get another reminder on a consistent basis let's say every 7 days. You get to set the parameters every 7 days until you get paid. So again, why these tools are so important is that it increases your capacity as a business owner to not have to constantly be going through your books. You set the information, you set the reminders so that you'll either get the reminder or you can set aside time once a week just to make sure you go back and evaluate how things are going. But these tools are meant to free you up to focus on product development, customer service, your sales activities, and the software then allows you to just have confidence that all of your bookkeeping is being taken care of.
Thank you, Rowan. This was helpful. And if you guys have questions for Rowan, please, I'll send a follow-up email with his email and you can reach out to him. But thank you, and this was helpful.
All right, great. Well, thank you for having me, and I'm glad that it was helpful. And again, I'm happy to continue dialogue offline with anybody who still has more questions.
All right. Thank you, Rowan. Okay. Thank you, everyone.
Thank you.